In this video, we're going to be looking at the cost of preferred stock, the cost of equity, and a few other issues, and then we're going to tie it all together and hopefully be able to show you how to calculate the weighted average cost of capital for your firm in a more practical way, because the textbooks usually don't do this in a real practical way. So we'll be looking at this from outside looking into the firm. So to begin with, we're going to look at the cost of preferred stock. Preferred shares, although their equity acts a little bit like debt, and quite frankly a lot of the more recent stuff, and if it's issued in the US right now, it feels a lot like debt too. Even though it doesn't count like debt because you're not obligated to pay the preferred dividend, it really feels a lot like debt. And in fact, quite often they even have a buyback clause, which makes it usually act a lot more like debt, since the firm is going to actually be paying them off eventually. They have to be paid, though, before you can pay any dividends to your common shareholders. Preferred stock is used by very, very, very few American firms. About a year ago, I tried to find examples of preferred stock in American firms for one of my undergraduate finance classes, and I had a devil of a time finding any firm in the US that is publicly traded that actually issues any preferred stock. And even when they do issue some preferred stock, it usually doesn't count for much. So for weighted average cost of capital calculations, the cost of preferred stock, even though we should include it, it probably, I'm going to tell you how to do it, but it probably isn't going to make any difference in the weighted average cost of capital, to be honest with you. So for completeness, the cost of preferred stock is going to be equal to the dividend that's paid on preferred stock per year divided by the current price of the preferred stock over times 1 minus f. Now the price times 1 minus f, and by the way, f is the flotation cost. That's how much that as a percent it costs to float a new issue, and the price p sub ps is the price right now. So if we actually had to raise more preferred capital, we would be raising, at least for internal purposes, the price times the 1 minus the flotation costs. That's what we'd get out of it, and what we have to pay for it is the dividend, and therefore the dividend over the price that we end up with is the return, the required return, or the cost of preferred stock. I'm trying to make it make sense, because it makes perfectly good sense to me, and yet I find that I must be speaking, Chinese to some of you, unless you speak Chinese, in which case I must be speaking a different language. So the cost of common equity, yeah, that's all there was to the cost of preferred stock. Now we get on to the cost of common equity. For common equity, we have already used the capital asset pricing model to estimate R sub S. We're going to use that again, and that looks like this. It looks like R sub S, which is the required return to the common shareholder, is equal to the risk-free rate plus the risk premium times beta. Now the risk premium is Rm minus R sub Rf. Now the R hat M just means the expected return to the market. So if we take the expected return to the market and subtract from that the risk-free rate, we get what's called the risk premium, Rp sub m. The reason that that's interesting to note separately is that we should be able to use the RS that we estimated in the earlier chapter, but here's the big point, and that's the beta that we multiply should be multiplied by Rp sub m, and the RF, well, how can I put this? The capital asset pricing model, as stated, is actually the output from a regression model. The regression model actually estimates the intercept term, which would be the R sub RF, and the beta. We do not use the R sub RF that it estimates in the capital asset pricing model. Instead, we use the risk-free rate because that's what the theory says. I mean, this was derived from theory, and therefore we're going to use the risk-free rate. And honestly, the intercept term that's estimated from the model is estimated with such a wide confidence interval that we really can improve the model greatly if we just use the risk-free rate. So that's what we're going to do. Instead of estimating the components of the market risk premium, in other words, the expected return to the market minus the risk-free rate, we're going to use just the one component. What is the difference between those? And the reason for that is because it doesn't seem to bounce around quite as much. It's not as volatile as the individual components. And therefore, how in the world should we do that? There are several ways that have been proposed to estimate this market risk premium, this RP sub M. The first one is, what has been the market risk premium over the long term? The answer to that, at least according to our book, is 6.6%, which seems a little on the high side right now with very low interest rates. Some people have approached this by saying, well, why don't we send out surveys to people who should know, like chief financial officers should know, but then they ask them to reflect upon the entire market, not just their firm, but the entire market. And then the CFOs say, well, I'm thinking over the long run we're going to be getting about 4.35%. That's what the average was, by the way, if you're wondering. How did they come up with such an odd number? It's because it's the average. If you ask a whole bunch of finance professors, they'll tell you that average is 5.7%. No, I was not asked, so I was not able to give them that. Financial analysts, a survey of financial analysts came up with 5%, and companies themselves in general say 5.5%. And I don't know what the companies means, but that's what they ended up saying, okay? Observable risk premium on publicly traded stocks is another possibility, and what I mean by that is actually taking the market risk premium and saying on a whole bunch of stocks, and all we're doing is taking this and guesstimating. Okay, so we get the dividends that they're paying, and by the way, the D1 in this case stands for the dividends expected throughout this next year over the current price. That's what's called the dividend yield, plus G. And what most people will do is they'll take the S&P 500, those 500 stocks, and do D1, guesstimate what D1 is, divide by P sub 0, add G. Well, how do they get the growth rate, long-term growth rate? They look, again, going back up to number 1, at the historical growth rate. So based on the historical growth rate of 4.4%, and the expected dividends based on what has been happening in the past, and maybe a little growth and in many of these instances you can tell pretty close what the growth should be this year divided by the current price, so far so good, we would get R sub M for every component of the S&P 500. And once we do that for all of them and we average them all together, it tends to average to about 6.56%, which interestingly enough is really close to the historical long-term average of 6.6%. It would round. So the authors of our textbook usually use estimates between 5 and 6%, which is usually what I've done in the past. I usually end up at either 5 or 5.5 or 6%, depends upon how I'm feeling that day. They further say that anything between 3 and 7% is acceptable. I would say that anything outside the ranges that are listed here is probably highly suspect, which basically means if you're outside of the 4.35 to 6.6%, I'm going to call BS on you. Okay, so again, getting back to how in the world, what are you talking about, and how do I plug this in? Let me go back to here, because at this point the R sub S is equal to the risk-free rate, which we have, plus RPM. That's the one we just talked about, somewhere between 4.35% and 6.6%. I usually stick between either I do a 5, a 5.5, or 6%. That's usually where I am. Depends on how I'm feeling that moment. And then we're multiplying that times the beta, adding it to the risk-free rate. We get the R sub S. Okay. That's just, I'm trying to be really clear on that. And at this point, we're ready to recap, and then I'm going to do this. Okay, weighted average cost of capital is a weighted average. As the name implies, we're going to take the W's that we got from our target capital structure discussion, and we're going to use the R's that we have been talking about all the way through this semester, multiply the two together, throw in a T, and we're done. Now the problem is you're going to be looking at that and you're going, oh my word, that's really long. Well, usually this is what we're looking at. WD times R sub D times 1 minus T plus WS times R sub S, period. That's it. In almost every instance, in fact, I think in every instance I've ever done in the last decade of working with Rocky Brands, that is the only formula I use, because they have no preferred stock, so the WPS would be 0, and any short-term debt that I've used that I think they should be moving over into WD and RD and those long-term debt things, I just move over there. At that point, I'm going, okay, that simplifies to this far simpler equation, and so that's the one I'm going to use at this moment. I'm moving back to the homework assignment that we just finished on capital structure, and I'm going to put a new sheet in front of it, even though it doesn't look like I am. I'm moving it there and double clicking on it and doing WACC, enter. And in this chunk is where I'm going to put all of that debt stuff. Now I've already shown you how Rocky Brands used to have their debt split up. Right now they only have one outstanding debt issue, which makes it far simpler. So if you need to look at the other one, I would suggest opening up the last video and scrolling through almost to the end where I talk about how to do this when they have more than one debt issue, because a lot of you are going to end up with not just one, but I have a bunch. So I'm going to be doing this. I'm going to say RD calculations, just so that we know what segment of my sheet I'm looking at. And actually, I'm having my issues, with Calibri and virtually everything else. I have to be different. So bear with me as I change my fonts and get my subscripted D. Probably need to capitalize calculations because this is kind of a heading. All right. And might as well make it bold while we're at it. There we go. So at this point, I need to look at the weighted average, or actually the cost of debt. So I'm looking at cost of debt. With mine, I would say weighted average, except they only have the one debt component. So I'm going to be doing RD. Then I'm going to be looking at the tax rate, and then getting the after-tax cost of debt, which is going to be the RD times 1 minus T. And having done that, I need to now subscript my D's. I cannot figure out how to subscript on that. That's why I keep avoiding it. You know, you'll highlight, then you go up here and it will do this little thing for you. But it's just increasing and decreasing font size, which is not what I'm interested in, which is why I want to say, get out of my face, because I need to subscript it. And by the way, subscripting not only changes the font size, it actually makes it go a little lower. So that's why I like the subscript. So if you're wondering why I'm so anal, that's why, okay? So anyway, at this point, I need the R sub D. Now, what we should be looking at for R sub D, as was already pointed out, is after flotation costs, which could include points. The problem is my 10K doesn't tell me how many points or what the fees are on this, although realize that this R sub D is probably understated slightly. So I'm going to go look at what the interest rate is on it, realizing that this is an understatement probably of the actual cost. Okay, this is my amortization schedule that I did earlier for this company. This one is just using essentially a revolving loan, and it has a 2.04% APR interest rate on this, which is really the current LIBOR rate plus 1.5%. I happen to know that, but don't ask me why. So the current LIBOR rate is actually rather low, so it's going to be 2.04%. So 2.04%. My tax rate. My tax rate I've actually calculated up a couple of times. It's the average tax rate. I really should be looking at the marginal tax rate. And my average tax rate is found right down here at the bottom, and we're looking at highlighting all of them and looking at the very bottom here, and it says 32.69%. I'm going to estimate it using a 35% rate, therefore, because it will be a little closer to the marginal tax rate. So in this case, I'm going to say 35.00%. And my RD times 1 minus T is equal to the 2.04 times 1 minus T, close parenthesis. You know, whenever I watch these videos afterwards, it kind of irritates me that I have that cell pointer on top of those, so I'm having to move it all of a sudden now because I've been watching them going, that's really irritating. So I need to change that to percent. And my after-tax cost of debt's 1.33%. I'm going to move down and say, so what is my RS calculation? RS calculation. You know what? I think I do want to skip at least a couple. Seems really scrunched unnecessarily. So again, I'm going to subscript my S because I'm anal that way. And again, make sure that if you needed to get there beforehand, that you're looking at a weighted average R sub D. Before I move on, I need to re-emphasize that, okay? So R sub S. With R sub S, we're going to be taking a look at the different components, which are the R, RF, the RPM, and the beta. And yes, I'm having to adjust each one of these so that we get the subscripts in the right place because I'm anal that way, so deal with it. But we're going to be there really, really quickly here. So, and the B I want to make into a beta. Our textbook I think actually uses B, but the traditional ones say beta. So there you go. And I usually will put beta sub S, but in this instance, no. That's a little too much anal for me. So I'm going to look up my R sub RF. My RPM, I'm just going to say 5.50%. And the beta, oh, and then I'm going to end up with R sub S. Forgot that one. So, again, one more subscript. And then I'm going to look up the R sub RF and the beta, and then I'll calculate the RS. Okay, so here we go. And this one comes again from chapter, I think it's chapter 6 homework. I'm hoping you remember doing this one. We have something that's statistically significant, and we end up with a beta of 1.284824. And if I pop back over here and say, what was the most recent average, monthly average, it's 2.77% on our risk-free rate. So 2.77%. And the beta is 1.28-ish. Actually, I think what I'm going to do with that one, since I'm incredibly anal, is highlight here, copy. If you highlight here, by the way, you're copying just the text. So I've copied just the text. I'm going to hit escape, so that is no longer highlighted, and then pop back to my weighted average cost of capital sheet, and then say paste. Doesn't matter which one, you goof. And it drops it in there. It drops it in there as a text. So I don't actually have to adjust the formatting, by the way, just FYI. So equal RP, well, let me do it in the order that it states. So that one plus that times that. Notice I don't really have to use any parentheses because order of operations says that you multiply first. And therefore we get a huge number because for some reason Excel decided I wanted 25 different decimal points, and I don't. Doesn't add anything. So we're going to pop that one back. And at this point we can do our weighted average cost of capital. So I'm going to say WACC calculation. And we're just going to use the formula. And again, let me point out what formula I'm talking about. I'm going to be using this formula here at the bottom because my company only has debt and equity, which is typical. So I need the weight of debt, I need the cost of debt times 1 minus T plus WS, the weight of equity, times the cost of equity. I have everything in the sheet that I need. They may not all be on the same tab, but they're on this in the same file. So we're ready to go. And here we go. So weighted average cost of capital is equal to WD. I'm going to go down to the target capital structure, pick up my WD, which is in the WD column, and I need the target. And I'm going to say times, I'm going back over to the weighted average cost of capital tab and multiplying it by the after-tax cost of debt, which is the RD times 1 minus T. Plus, now I need the weight of equity. Again, we're going back to the target capital structure tab, going to the WS column and all the way down to target times the cost of equity, which I just calculated on my WACC tab, so I'm going back to that tab and getting my R sub S. Now I'm going to hit enter, and I'm going to change the formatting. And my estimate of the weighted average cost of capital right now is 5.29%. Now, let me do a couple of other things here really quickly, and that is compare to, this is my levered weighted average cost of capital. So I'm going to call that, this is really the weighted average cost of capital that, under its current capital structure, target capital structure. What would happen if we got completely unlevered? Weighted average cost of capital, and I'm going to put in here unlevered. So, and by that I mean what happens if they pay off all their debt. I always have people say, this company would be doing a lot better if they would just pay off all their debt. And I'm going, no, actually not. So remember, this is the discount rate for all of those free cash flows that we've been talking about. And so here we're going to be looking at the unlevered weighted average cost of capital. And believe it or not, we do have that. Because if they had no debt, the W for this component up here would be 0. So it would be 0 times 1.33% times 1, because all of their weight now is in equity, times the unlevered cost of equity. So therefore, it's just the unlevered cost of equity. And unfortunately, I did not put the equal sign, so I'm going to have to do that all over again. Equal, go over to your Hamada tab, and go to the very top one where they have debt to equity 0, and I'm going to hit enter. Now, typically what happens at this point is people go, oh really? I actually have a lower cost of capital with debt than I had without it. This is the beginnings of the aha moment, where the company has debt because it's less expensive on my capital side to hold debt in my capital structure than it is equity. Why? Because I'm looking at the weighted average of those two. And whenever we compare those two, we're going, okay, 9.84%, that's really pricey, versus 1.33%, that's really cheap. I think I want some more of that, 1.33%, rather than the expensive 9.84%. Which brings us back to the lecture. We've applied a little bit. We're going to apply just a hair more in just a couple of slides. So here we go. We're going to now look at marginal cost of capital. If the company expands, they're going to have to expand all of their capital, which means more flotation costs for debt and more flotation costs for equity. And so far we haven't talked about the flotation costs for equity. As more and more capital is added to the firm, the cost of each component typically increases. The reason for that is because the markets don't know what the risk is of the new parts of the company, the pieces that you're just adding, the pieces that you're borrowing or raising extra capital to invest in. And because of that, it adds a little bit of risk, and therefore you need a little bit more in the way of return. We've discussed how the cost of each component should include flotation costs. We have not talked about that with the equity thus far. If new equity is needed to be issued, the new equity will cost more than the old equity because the old equity investors, the ones who've been here for a while, will require the same RS because that one's based on risk versus return. The new equity investors will also require the same return. However, they're going to have to get that same return as all the new investors, plus any new investment will have to get that return, plus a little bit more to cover any flotation costs. So to find the expected cost of new equity, our textbook gives us this little formula, R sub E, the expected R sub E, which is going to be equal, they say, if the markets are in equilibrium, then the expected RE will equal the RE, and that's kind of what they're saying. And therefore, what they're looking at is a relationship that's based on something that was derived from the Gordon growth model. Now, the Gordon growth model would have done the P sub 0 is equal to D sub 1 over R sub S minus G. Then if we solve for R sub S, we get R sub S is equal to D sub 1 over P sub 0, and then that whole thing is added to G. Now, that's where we're starting this story, and then we say, but the P sub 0 is not what the company gets. The company gets P sub 0 times 1 minus F for the flotation costs. Same thing that we were talking about with our preferred stock. To show how much of an adjustment R sub E is from R sub S, let's return to the initial Gordon growth model. P sub 0 equals D1 times R sub S minus G. And again, if we were to solve for R sub S, we get something really similar to what we have in R sub E, except for the 1 minus F. The point here is, if everybody wants the same kind of return, let's get R sub E in terms of R sub S instead of this P sub 0 thing in the middle. So, being the algebra nerd that I am, I'm going to substitute this second equation, P sub 0 equals D1 over R sub S minus G, into the first equation. So where it says P sub 0, I'm going to be replacing. And here we go. Now, as it so happens, because we have a D1 in the numerator and the denominator, they obviously, well, as we said in elementary school, they cancel out. The R sub S minus G in the denominator is actually in the denominator of the denominator, which puts it in the numerator. Yes, you guessed it, as if you remember your... I swear I learned this stuff in elementary school, but I'm so old now I don't remember where I learned it, so it really collapses into this mess, okay? And there's a couple of points I wanted to make based on our derivation here. First off, this derivation's not in the textbook. I've never seen it in any textbook. But it's easier to deal with than the messy model that they give us, because for one thing, I'm going to point out that Miller and Modigliani would be proud. Dividends still don't matter, which means we can use this formula on companies with any dividend policy, including, I don't think we need any dividends, because notice the bottom line at this bottom line is dividends aren't in the model, and therefore Miller and Modigliani would be happy. Also note that if there is no flotation costs, in other words, if F goes to 0, what we end up with is R sub S minus G over 1. Oh wait, that's just R sub S minus G. So R sub S minus G plus G is equal to R sub S. The only reason R sub E is higher than R sub S is because of the flotation costs. And note that as long as F is not 0, well, I should say is greater than 0, then R sub E is going to be bigger than R sub S in every instance, and it doesn't matter what G is. If you need to, you can play with that a little bit to convince yourself, but it is always bigger. So if you get an R sub E that's smaller than R sub S, be sure of one thing. You did it wrong, okay? Make sure you get the parentheses in here. And so in this instance, I'm going to be using for my company, I'm going to be using a G of 2% again, because in this instance, we're looking at growth rates essentially in the free cash flows, which I'll talk about in a minute. So they aren't necessarily the same animal that we've been talking about thus far. So I'm going to just start with the 2% again. So here we go. I'm going to move next door over here and say, let's figure out what R sub E is. R, E, oops, let's do an E instead of a 3, wow. And then I'm going to be highlighting my E and subscripting. And by the way, I can do lots of things in Excel, but I can't even put a hat over the R. If anybody knows how, please let me know. But aside from drawing it, which looks always really crappy, but that's as close as I can get to R hat sub E. And I'm going to be happy with that. So equals. Oh wait, before I do that, I need to move this down. Hello, because I forgot to put my G. G equals, oops, 2.00%. Let me get my percent. Wow. Okay, I've forgotten one extra little thing, and that is my F. This is my flotation costs. These have to be stated as a percent. So I'm going to assume 8%, okay, just for fun. Boy, didn't matter what I did. That's a goof. Anyway, so I'm going to say now R sub E is equal to parenthesis R sub S minus G divided by, open parenthesis, 1 minus F, close parenthesis. Now we have two parentheses, one divided by the other, and then once we've finished with that, we can do our plus. So it will do the stuff in the parentheses first, then it will do any multiplication and division second, and then it will do the G. In this case, I just need to add the G. And my R sub E should be bigger than 9.84%, just so we know. And it certainly is. And in fact, Excel decided to make it look even bigger by adding all the 20 trillion decimal points, which is really irritating, but okay. So I'm back to 10.52%. So you may say, why did we have to do that here? Because then if I have MCC, here's the point. If we have a marginal cost of capital, so at some point, if I'm adding this as my debt, cost of debt, and this is my equity, cost of equity, because at some point I'm going to run out of retained earnings. And I'm going to have to just issue more equity, so I'm going to have to issue it at that rate. Wow, that's expensive. I know that's not a term, but what the heck. So I'm going to say, what would be the marginal cost of capital in that instance? This is just a way of saying, do you get this concept of marginal cost of capital? Marginal cost of capital in this instance, if the next thing I had to add would be equity, would look like this. We would say, well, what is the W for D? You're going, why? Where did the D come from? Whoops. Times after-tax cost of debt plus weight of the equity times the new equity this time, because that's why it's different from the last one. And this has gotten a little more expensive. Still hasn't gotten so expensive that it makes more sense to do that than unlevering my beta, though. Just saying. And at this point, I think we're going to call this one video, because at the last chunk, we're going to have to do some valuations using our weighted average cost of capital and probably our unlevered weighted average cost of capital, because I want to make the point that typically the reason companies have debt is because the firm is worth more with debt than it is without debt. And the easiest way for me to make that is actually have you calculate both ways and then go, oh, it's worth some more money. Usually what's odd is it's not worth as much money as you might think it would be worth, but anything should be motivation enough for a manager whose goal is to maximize shareholder wealth and the value of the firm. So that's it for this lecture. I'll see you in the next.